welcome to what I imagine is likely to be one of the most interesting presentations of the week. And welcome to Matthias Siller, manager of the Barings Emerging EMEA Opportunities Trust. The trust invests in emerging Europe, including Russia, the NAV of which the board wrote down to zero at the start of March. This shocked the portfolio comes after a period of strong performance for the trust, which broadened its mandate in 2020 to include the Middle East and frontier markets in Africa. And I'm pleased to welcome Matthias to this session at what must be a particularly busy time for the team. Before I do that, I would encourage you, as usual, to make the most of your access to the manager's expertise in the region by using the Q&A function to ask questions, which we'll come to at the end. Over to you, Matthias.
Thank you, Pascal, and hello, everyone. Thank you for giving me the time to present on Barings Emerging EMEA Opportunities. So, this is a portfolio and a trust that I've been working on and managing for quite some time. I'm happy enough to do this with two very esteemed colleagues, Maria and Adnan, and we're implementing a bottom-up driven investment process that's based on groundwork and gathering information from companies directly in cooperation with a team at Barings that's dedicated to the entire region. We then process the information into our process, which is based on growth at a reasonable price, and implement our ESG integration strategy to make sure that we are adequately covering the ESG angle from also from our firstly in-house and also from a bottom-up perspective. This is our day-to-day work, which then finds its expression in the portfolio of Barings Emerging Emerging EMEA Opportunities. By doing that, we invest across various countries in the EMEA region, out of which up until recently the largest were Saudi Arabia, South Africa, Russia, the new EU member states, Turkey and Greece, plus other Middle Eastern nations and sub-Saharan African countries. So it was a very broad mix that was one of the key strengths of our trust. We believe it's designed to combine uncorrelated sources of markets that are idiosyncratic to each other and present a semi-efficient environment for various reasons, be that it's the development stage of capital markets that's still in the growth phase, be it that information is much more difficult to gather and that not so many investors follow the market. But overall, we like to emphasize that we believe that the EMEA region is a region where we can achieve a certain amount of diversification that should make the underlying portfolio performance quite resilient to international development, but also to the development of any single market within the portfolio. So this kind of resilience was very much tested this year with the situation in Russia and the war of Russia on Ukraine. But I can highlight, whilst we have suffered from marking, as Pascal highlighted, marking our Russian holdings to zero in accordance with international standards. We have actually seen this very diversifying effect that I was highlighting at the beginning of this conversation coming into stage, and we saw that big markets and big constituents in our portfolio did indeed perform positively and therefore softened the hit that we incurred in Russia. With regards to Russia and the contagion effect that it has, so I want to address Russia at the beginning and then expand on the wider EMEA region to get this particular issue out of the way. We believe that we believe that the situation that Russian energy currently the way that the Russian energy situation currently affects especially Europe will change dramatically in the future. As you can see on the right-hand side panel here, Russian gas deliveries have been one of the main sources of the strong increase of gas in the European energy mix. We think that this tragic events around the invasion of Ukraine will change the policy profoundly, and we're going to see a pivot away from Russian energy and especially Russian gas in Europe over the next 5 to 7 years, to a point where Russian gas will be entirely phased out of the European energy mix. So this is, of course, a strategic folly from Russia, but this is a clear result of the events that have taken place over the last 2 weeks. We think that this will also create opportunities from the perspective of an investor, especially with regards to infrastructure, energy infrastructure, and the acceleration of the European Green Deal. And we believe that various companies in different countries of our investable universe will actually benefit from that. So we're doing currently a lot of work trying to understand which companies and which infrastructure companies and which infrastructure region especially will benefit from that. Is it LNG? Is it electricity generation? Is it electricity transmission? Is it construction companies? And so on and so forth. So that's what we are currently doing in the portfolio, and that's what one of the clearest effects on the that we're going to see is clearly the phasing out of Russian gas from the European energy mix. This is kind of a first assessment how this tragic events are going to affect our portfolio on the European side of things. If you then go on beyond Europe, you can see on this chart that we're investing in far more countries. So as I pointed out at the beginning, this is clearly focused on EMEA. What unites these geographies is mainly the time zone, not much more than that. So this is the diverse background that I highlighted. And we do, as I pointed out at the beginning, use a bottom-up research process that focuses at growth at a reasonable price to identify investment opportunities in various geographies that you see highlighted in green on this page. If I can sum it up quickly, going from south to north, it would be clearly South Africa and the sub-Saharan part of Africa, plus the Middle East and North Africa, then the transition, then the kind of energy corridor that Turkey might become in the future, plus Greece, who has recently been admitted into the developing European space, plus the new EU member states of Poland, Czech Republic, Hungary, and Romania, and Kazakhstan. So these are the main investment areas where we invest, and we believe that this constitutes an investment area where we can find yield for our portfolio, where we can find growth for stock performance, where we can find diversification for resilience, and last but not least, where we can find inefficient markets due to since they are not mainstream and not followed by a large amount of institutional investors. This we hope will continue to give us the kind of edge that we need to implement our investment process in a way that it will generate outperformance over the relevant index. The main driver for a lot one of the main drivers for our portfolio going forward, we believe, is going to be the energy transition. We do invest in geographies that are uniquely exposed to raw materials that will enable mankind to achieve exactly that. On this chart, you can see, and on this chart, you can see highlighted various raw materials, but also technologies that will be playing a key role to allow our society to transform the way we are living and the way we are consuming energy. We believe that this is absolutely crucial. We also see that from the perspective of the future development and securing future global growth, but also from the perspective of the policy environment. In other words, we believe that there will be a lot of capital be provided from not only institutions, but also governments to secure this. And what we've seen happening and what we've seen being debated and processed at the European Union space last year is exactly that. This European Green Deal is exactly pointing towards this transition. Now, we are acutely aware that what happened, what is looks easy on paper, might be much more difficult to implement in the real world, and we see that the kind of price performance of various raw materials, especially in the metal space, highlights that there are sufficient or substantial supply-demand issues to be expected going forward. On this slide, you can see our assumptions and how we think that, in the medium-term outlook until 2028, the situation presents itself across key materials that will allow the energy transition. And the common point of view here is that we are being confronted with a substantial scarcity in key raw materials. Therefore, we believe that it is fair to assume that those incentive prices must stay high to incentivize further production and investment into mining assets going forward. And therefore, we are quite confident that the raw material prices of the various elements that are necessary to make the Green Deal and the energy transition happen stay high. This obviously benefits one of the key producers globally, and that being South Africa. That's South African stocks are a key element of our portfolio. And you can see that this has a very substantial effect, not only on the stock prices, but also on the overall macroeconomic backdrop. In South Africa, we do believe that the ongoing reform drive, arguably, long overdue, but we do believe that the ongoing reform drive of the South African government will be supported by this very beneficial tailwind that we expect from the budget revenues that are being generated from exports of these key materials that we highlighted before. So this should therefore propagate a positive effect not only in certain commodity-related sectors in South Africa, but also in the financial and in the consumer sector. And we already believe that the stock market is picking up on this theme as we see performance the positive performance we have seen in the metals and mining sector in South Africa actually starting to also occur in broader sectors in South Africa. Also, the currency is positively affected by that. The South African rand has been one of the best performing emerging market currencies as of late. On a similar pattern, but somewhat more specific and more energy related, we do believe that the Middle East is also positively affected by that. Clearly, the recent events with regards to Russia becoming an international pariah state do put Middle Eastern energy producers into a much more beneficial situation than before. These are indeed now key players and also key partners of the West with regards to energy security. But more than that, we do believe that given the relatively limited amount of hydrocarbon, especially on the oil front, hydrocarbon lifespan or economic lifespan, we think that this grave mistake that the Russian leadership decided to embark upon allows the Middle East to make a much better use of its recoverable reserves in the remaining time span, and will also encourage South African producers such as Saudi or Qatar to increase their investments, especially in gas, as this is of course a key and much more important hydrocarbon and so-called bridge fuel to the sustainable energy of the future. Therefore, we believe that we are going not only to see a windfall in terms of cash flow generation, but we are going to see an increase in terms of investments in hydrocarbon production and related industries such as petrochemicals or other industries that are related to hydrocarbons, such as fertilizer production, for example. So we're going to not only see increased cash flows in the region, therefore increased consumption. We do believe that also this region now plays a very important role to secure energy assets and energy supply in the future, and therefore we're going to see a pickup in terms of investments in the region, we believe. And that takes me to the next slide. These investments will, however, not only be confined to the energy sector. We think that under the vision, so-called Vision 2030, the Saudi state will try to broaden the appeal of reforms and therefore investments into areas that affect the wider society of Saudi Arabia, and more importantly, invite international investors to contribute and to co-invest in this space. Therefore, we are going to see, therefore we're going to see, we believe that we're going to see a wide range of IPOs on the Saudi Arabian markets. We have, for example, also therefore invested in Tadawul, the Saudi Arabian stock exchanges. We believe that this key infrastructure is going to play obviously an important role here and benefit from the deepening of the Saudi financial markets. This is certainly a key element of this wider structure. So to sum it up, in Middle East and North Africa, we think that this region is becoming geostrategically much more important. It will also be rewarded with cash flows from elevated oil prices. We think that contrary to the past, these cash flows will not just be funneled away or consumed. They will be, to a large extent, also invested into growth projects that aim to allow the Saudi society to transform its underlying business model up until 2030 to one that is much less independent of hydrocarbon prices. Therefore, you're going to see a wide range of opportunities in the IPO space, where investors will be allowed to co-invest with and invited to co-invest with local investors. If you now move to Central Europe, this is mainly the new EU member states, Poland, Hungary, Czech Republic, Romania, and I will also include Greece and Turkey here. These countries obviously are affected by the events in Ukraine much more than the areas that we have just talked about. Indeed, when we look at South Africa and Saudi, these are markets that have actually gained since the beginning of the year in US dollar terms. So this is a very strong performance and testament of the diversification effects that we see in our portfolio, as I discussed with you at the beginning of my presentation. On the other end of the spectrum, the new EU member states, Turkey and Greece, that first of all suffer from the sheer fact that they are very close to the theater of war. So there's certainly a risk element and a risk spillover element that has affected risk premium in this region. But also a lot of those countries, especially the new EU member states, have a very large component of their energy mix stemming from Russian gas. So this is larger than the overall EU mix of 25%. In some cases, it can be up to 50%, and that's of course that represents a large risk, supply risk for this region. Also, these countries are uniquely exposed and to inflationary shocks, since they are part of the EU gas mechanism, and EU gas prices are extremely high. So there's also an element of inflationary shock that affects those countries. So all in all, of course, quite a toxic mix, I hear you say. However, we want to point out that we believe that these countries, these small open economies, are extremely resilient. And yes, while they suffer from a drop in global trade, we do believe that they will ultimately benefit from three major developments over the next couple of years. Firstly, nearshoring. We think that supply chains will be moved closer to the ultimately source of consumption or production. In that sense, we believe that the export powerhouses of Europe will make sure that a larger part of their suppliers will sit at their doorsteps and will not be, thousands of miles away. And you can only, of course, make this happen when you are extremely efficient in terms of unit labor costs. And we do see that, whilst household incomes do rise substantially, we also see that productivity is still increasing in line with household income growth and wage growth, and therefore unit labor costs are actually still extremely competitive in emerging European countries. And we think that that will lead to a boom in terms of investment for nearshoring industries closer to the source of consumption and production, and that is Europe. That will be the first pillar of support. We think the second pillar is the very EU Green Deal that have been highlighted. These are billions of euros that will be granted to various EU member states, but especially the still very much hydrocarbon dependent new EU member states to transform their energy systems and make it more efficient. So we're going to see, a lot of investment. We're going to see a lot of investments in this space, be it electricity transition, be it sustainable electricity generation, be it decarbonization of existing energy generation. So all of that will, I think, be a massive fiscal boost to those economies, and will come at exactly the right time. Thirdly, we believe the market underestimates the quality of balance sheets, be it household, be it national, or be it enterprise balance sheets in the region. We have seen them, we have never had extremely high leverage in new EU member states, but over the last couple of years, this leverage actually was driven down further, and even COVID did not alter this picture substantially. So we do see very strong balance sheet and ample cash reserves in the region, and we think that that will provide a lot of resilience. And there's to not only companies but also society as a whole, and therefore we do not see any kind of risks of sovereign stress or systemic failure in those countries. And at the same time, stock market valuations have come down a lot, and we believe that therefore, for the three reasons specifically that I've highlighted to you, we think that there's now time to actually invest in those countries to be able to benefit from what is going to be a much faster way back to normalization than what many market participants believe from our perspective. May I draw your attention also to the chart on the right-hand side, where you see how fast long-term interest rates actually went up. So this is also an interesting perspective. This is the long-term interest rates in Poland, Romania, and the Czech Republic compared to the South African long-term interest rates. You see how stable the South African situation has been over the last couple of months, and that's testament to the very stable and positive development of the underlying economy with regards, and that of course. The reason for that is, as I highlighted, in a rapid rise in commodity prices. Whilst the small open economies of emerging Europe have seen their cost of capital and their long-term rates going up quite substantially. This is a stark contrast to what we see in the rest of Europe, right? Where we're discussing right now how many rate hikes we are going to see, and we learn more about that in the US. Will it be 6 or 7 over the next 2 years? And to a certain extent, there's a similar discussion in the UK, but certainly not in Europe so much, where we're probably going to see 2 or maybe 3 rate hikes going forward. So this is an extreme anemic environment in Western Europe, and around the euro and all the and the so-called eurosclerosis that this common currency has brought to certain parts of Europe, right? So it's interesting to see that the part of Europe that is not in the Eurozone sees a much more dynamic evolvement in its long-term interest rates, and therefore also the expected short-term path of interest rates. And that, I think, gives those economies just more tools especially on the monetary side of things, to adjust for a weaker economic performance going forward. But as they can cut rates again going forward, which is certainly not something that we're going to see, to the same extent in other parts of Europe. So there's definitely, we think, an advantage. It's also very interesting to see that those economies can actually generate growth and operate nicely under interest rates, under levels of interest rates that would be rather unthinkable in other parts of Europe. So we talk about 4, 5, 5.5% in countries like Hungary or Poland, where we expect these are levels where we expect rates to peak in the next 8 to 10 months. This in itself, will also provide the banking sector, which with a very nice support with regards to earnings. Is also something that we're not going to see in other parts of Europe. Clearly, the net interest margin will be positively affected. The margin that banks actually profit from when interest rates are rising. This net interest margin will be positively affected by rising interest rates, and that's we think is something that sets the financial sector in emerging European countries apart from the financial sector in the developed European part. And we do think that therefore banks and insurance companies will benefit from that, and we will see the market find out about this extra buffer going forward. Yes, and this brings me to the Q&A section. But before we do that, let me just highlight the structure of the portfolio to you, and also say a word or two about the underlying revenue generation that sets the tone for our dividend policy. First of all, with regards to the current portfolio, you do see that we are focused in terms of geography. We continue to be focused on Saudi Arabia and South Africa, and I've hopefully highlighted the main, why we think this, so far have been very good investments, especially in 2022, and why we think that, there's more to expect from those two geographies going forward. You do see that we have less exposure to Central European countries, but hopefully I've also made it clear that we see a lot of opportunities currently popping up in this particular region. We are not enthusiastic about Turkey. Here we focus clearly only on a single stock that is quite an export champion, and a company that we think will do very well independently of the macroeconomic development or political development in Turkey. We are also so far not seeking more exposure to Greece. But likewise, to what I've said about the new EU member states, we do believe that Greece has a lot of positive things going for it right now. Not least, I think, a very capable government that we must not forget, is an important differentiator in the emerging market space very often. Yes, in terms of sector exposure, we do gradually shift back to financials. I've highlighted to you that before too, that we see that the recent sharp drops in share prices allow us to revisit the sector with more scrutiny and with more confidence. We think those companies and the respective economies are very well equipped to withstand recessionary and inflationary pressures, and that the valuations in many cases look very attractive. So the same goes for the consumer sector, where we also see opportunities coming back. We're more cautious on energy. That has been performing very well, and we are more cautious at this stage with regards to the future outlook of energy. Somewhat in the middle, materials and industrials. Here we are very selective. and keep an underweight, for example, in precious metals, whilst we still like the environment and the opportunity with regards to stock picks in the industrial metal space. So this is kind of sums it up nicely, I hope, with regards to the structure of the portfolio right now. What this means for dividends is and the underlying revenue generation that backs the dividend potential of the trust up is that we of course suffer from the fact that the large Russian dividend payers are obviously non-existent. However, there's not a drastic change to the overall attractiveness. We believe that at the current price level of about 530 pence, we do believe that there's a sustainable underlying dividend generation potential of around 5%, something sustainably insofar as that we believe it will grow over time. We think that this puts us in a situation where we can, where we don't have to shy comparison to income funds without having to sacrifice the growth potential that we see in our company. So this is a portfolio that focuses on growth at a reasonable price across, we hope, a diversified set of geographies in what we think are inefficient markets. That allows the portfolio to generate still an attractive underlying yield for our shareholders. So we hope we can marry yield and growth together with the opportunity for outperforming in inefficient markets via a process that combines ESG, in-house ESG, with in-house bottom-up research on a stock-by-stock basis. Good. So this was my presentation. I want to thank you for your time, and then I'll open the panel for Q&A.
Thank you, Matthias. We've got a few questions that come in. Some fairly specific ones, which I think are quite interesting. So margins and valuations both look very low in Poland relative to history, almost uniquely in most markets across the globe. How do you view the opportunity set in Poland?
Yeah, I think it's a very good question. Yeah, I think the opportunity set is extremely attractive in Poland right now. It's I think I made it clear or I hinted at it at the presentation that that's one of our key areas of involvement right now is Poland. So this comment is absolutely right. The environment, this environment that we currently see in the stock market is a very attractive one in terms of margins and in terms of valuations. Absolutely correct. I would highlight that our focus will be on consumer stocks, financials, and infrastructure. I would be hesitant to invest in energy in Poland. This is mainly still there are two reasons for that. First of all, I don't think that the ongoing merger in the energy space, in the refining space, will create any substantial value for minority shareholders. Secondly, it's still very difficult for me to understand how, on the utility side of things, how the state-owned enterprises that dominate the utility space will actually live up to minority interests. I still don't see that happening. So I'm very cautious on that two sides, i.e. utilities and energy, but I'm very confident on consumer financials and to a certain extent infrastructure.
Thank you. We've had a few questions concerning the Ukraine situation there. Putting aside the obvious humanitarian concerns, what's the best possible scenario for the remaining Russian exposure you have in the portfolio? What's the best outcome from your point of view for those holdings?
Yeah, it has to be without getting too specific, because that would be ludicrous from my side. It has to be an end of sanctions. That would not in itself immediately lead to a situation where we can recapture value that has been taken from us, but it creates a pathway to it, right? So I think it will be a multi-year process ultimately, but this process will start with the end of the sanctions or end of some sanctions. So this is a process that will start with that. what will kick this process off, other than peace in Ukraine, I don't know, right? But it has to be around. It has to be around the sanction regime and the change in the sanction regime.
Yeah. One more on that subject. If Russia successfully forces the surrender of the Ukraine, does that mean will that change your approach to other Soviet or former Soviet countries in Eastern Europe, which are outside the NATO alliance, which might one day be in a similar position?
Yeah, that's true. I mean, that's a good point. We try to address geopolitical risk with discount rates, and by introducing risk premiums to countries that are exposed to geopolitical risks. However, this kind of process has also its limits, especially when it comes to the outbreak of outright hostilities between the countries, right? So take Kazakhstan, for example, which is an interesting economy, but a country that is, but also a society and country that has substantial issues, and part of that, I think, is rooted in the fact that they are in the more or less in the Russian space and are subject to Russian considerations constantly. So this is something that, when I can avoid it, I certainly will avoid it much rather than former Soviet republics and CIS countries. When we can avoid exposure, we certainly will avoid exposure there for the time being. Simply because the investment process that I follow at these fringes of total war and totalitarian regimes exposing shareholders to total war, it simply doesn't work. Nobody would expect it to work. So I think common sense dictates, right, that you take your time and monitor the situation, but don't gamble applying an investment process that's just not being made for a black or white situation.
Mm-hmm. And there's a couple here related to ESG. So first one is a sort of broader one, and it's what part does ESG play in the strategy? Excuse me. What part does ESG play in the strategy? And if arms manufacturers are excluded, given the pivot towards rearmament as a defensive priority, is there any likelihood that they might not be in the future?
Yeah, it's a very good question. Thank you. I think my personal opinion is, so we haven't decided at Barings yet, but my vote is certainly that the defense industry should be an ESG industry. That's my personal opinion. I think it's also an opinion that would be shared by 41 million Ukrainians. That's my personal opinion, and I think that the great thing about Barings is that we have a culture that allows a debate and actually encourages a debate around that, and that's exactly what's happening right now. But so far, the defense industry has been not an ESG sector like everywhere else, but we are currently debating exactly that. That also highlights that ESG plays an important role at Barings. I personally have to admit that this is something that it's a bit of an acquired taste for me. I have to admit that I wasn't the first one to enthusiastically pick up on ESG, but I have started to learn. I've started to learn that it actually brings a very interesting, different perspective to investments, and it also allows us to engage with companies in a completely different way. What I mean by that is that that management boards do understand now much better than in the past the importance that ESG plays in the international investment space, and therefore engagements on that front are actually pursued from the side of issuers with quite some importance, I must say. That leads us to much more meaningful insight that we would have otherwise been able to get. It also and apart from that, clearly it also serves a very good purpose in its own right. Yes, so therefore we dedicate approximately 1/4 of our research time and exclusively to ESG-related issues. But I hope I could make it clear that I don't think these are empty miles. I think this is a very, very invested time for various reasons, but last not least also from the perspective of generating returns for shareholders. We have also seen, and that's very encouraging, results. So it's not us fighting windmills. We do see tangible results on various fronts, and that's not from the Barings perspective alone. Or this is of course us acting in concert with other shareholders, amplifying the message. But it's very encouraging from any level at Barings, be it the junior analysts to the CEO, that we can play an important part also in that respect. And I think we own it, and I think of course we owe it to our shareholders.
Thank you. Just looking at Saudi Arabia, obviously that is now has sort of gone up in terms of its weighting in the portfolio as Russia has gone down. It's now the second biggest exposure. Basically, that is a country with its own ESG challenges, to put it lightly. Obviously, you are invested there. It's going to benefit from a limited oil supply, and Russia's woes are to its favour in that respect. What steps can you take, or are you taking, or do you take to ensure that what you're doing there isn't at some point later down the line going to sort of bite you because of the problems that may arise as a result of similar things that are going on there to what's going on in Russia?
Yeah, so these are tiny steps, but they are much more than cosmetic. So engaging on ESG and means doesn't mean that we just open a sustainability report from a third-party provider, but it's that we engage with companies on predetermined fields of interest that we have identified at Barings that are also adjusted to the relevant geography that we talk to. And clearly, female empowerment, for example, and female participation in Saudi Arabia is something where we believe that the overall conversation is shifting into a completely different direction, and where we see a lot of evidence that things are moving into a very, very good direction. And we believe that the investment community has played a certain part in that too. Then also, if we are, I'm not going to say that there are situations where you're going down a dead-end street, right? In that situation, we would not invest, right? Companies that would simply not engage on certain issues with us, or simply not come back to us on certain issues, would not be investable for us. So this is how we see it. However, I have to admit that for the largest amount of companies, and especially also for companies that seek IPO on the Saudi Arabian market right now, I'm actually quite impressed with the kind of goals that they've set themselves, and also the amount they've achieved so far on that front. It's actually quite impressive. So overall, I don't want to sound naive here. Yes, overall, we are very aware of the situation with regards to human rights and beyond in Saudi Arabia. But at the same time, we think this is only the start of a conversation, and we feel actually emboldened by the progress that has been made so far, and we think we are quite happy that we can contribute to that a little bit. However, we clearly have to monitor it going forward. We have to keep on engaging with companies, and we have to make sure that every single investor and analyst at Barings understand that this is not a conversation that you have with management because you want to tick a box, but because you really want to make sure that you contribute to an underlying change of the environment.
Thank you very much. There's been a few questions about Africa and kind of what's going on there and why you invested there in the first place. So you've not really spoken much about Africa beyond South Africa, but just to break it down, why did the board decide to expand the remit to include Africa? What is your, where do you see potential beyond what's on that screen there, which is South Africa? So, within the other markets in Africa, and particularly one person has asked, do you see any potential in Nigeria, where oil revenues are strong and consumers aren't trouble rising taxes? What are the high points for you, and why aren't you in there yet? And do you intend to be in there in the future?
Yeah, it's also a very good question. So quickly, the board has identified the potential that we see in African public equity markets. This is not necessarily something that will express itself overnight, but we monitor it very closely, and we have invested, I think, very wisely and successfully in MTN, the largest African telecom operator. I personally think that telcos and telecom infrastructure is the place to go for me as an investor. I think this is kind of from the African perspective, mind you. I think this is a sweet spot right now that helps you avoid the pitfalls that are normally related to direct energy investments, while at the same time you benefit from the rising living standards and the cooperation with the local governments. This is kind of a win-win situation, I think, from the government perspective, local. Also, ESG-related issues, of course, come to mind, but also local households and local investors, and lastly, of course, the underlying profit generation. So I think this is the telecommunication sector in Africa. To answer your question directly, we are invested in MTN, which is one of the largest positions in our portfolio. We have been invested in MTN for quite some time, and we still like it, even after quite a substantial performance over the last couple of months. We think it's generally, we think its main attraction is its Nigerian and its Nigerian assets, and the way they've turned around what used to be a constant fight between them and the government into, like I highlighted, a win-win relationship that benefits the government, MTN shareholders, but also Nigerians themselves. We do hope that after decades of false starts, that for various reasons, right? Certainly, I can't blame any particular party to that, but we do hope that after decades of false starts, we've come now finally to a point where Africa can partially live up to the huge potential it has, and therefore we prepare ourselves. I highlighted to you that we have a team that is dedicated to EMEA. We have analysts that, including myself, that take up African coverage. As I pointed out to you before, so far we think the investable space is somehow limited. I personally prefer telcos at the current stage, but we do hope that that is going to broaden going forward, and that we can use our research capabilities to find more investments.
Yeah, and we've probably got time for one more question. It seems rather a long time ago that COVID was the sort of only thing anyone talked about, but that's probably a good thing. Are any of the countries in the portfolio likely to benefit from the loosening of COVID rules as that continues, particularly those which have got strong tourist industries?
Yeah, absolutely. I think that's one point that I highlighted. I think that 100% right. So Greece and Turkey are certainly the tourist hubs. You might also add Croatia. I personally find that all three countries have a great future ahead of them with regards to the tourism industry and how it could develop. I think they tick all boxes, so they are easily accessible from the perspective from the European market. I think that long haul travel, will become less popular, especially when it comes to beach destinations. I believe for ESG related, carbon related reasons. So I think that this kind of short haul destinations for the European markets, such as Greece and Croatia, to a lesser extent, but still Turkey, will benefit. I also think that the geopolitical tensions that we see, will make people less keen to travel wide distances too. So Add to that the loosening of COVID restrictions. I think Greece and Croatia are going to be big winners, and to a certain extent Turkey. The reason why I'm less confident about Turkey is that 25% of tourists in Turkey are Russians and Ukrainians, and I think this is going to this is going to dent numbers, of course, this year quite substantially. But in the long run, I think that also the Turkish tourism industry will see new highs. I think the 2019 was a record year, and we haven't been able to go beyond that. So given the situation this year, we're not going to see a record year this year either. But I think beyond 2023, I'm actually quite confident that also Turkey will see record numbers of tourism inflow.
Okay, I'm afraid that's all the time we've got for questions. We will be back in the morning, so please do tune in again tomorrow for our final day focused on specialist funds. Thank you everyone for joining us and the questions you've submitted and the time you've given us. And thank you, Matthias, especially for taking the time to talk to us today and giving us a really fascinating 45 minutes.
Thank you, Pascal, and thank you everyone who dedicated his or her time to me. Thank you.
Yeah.